Most of you aren't trading, you're gambling with a fancy interface. Man, if you want to reach $1 million balance in the next Stencers days, you have to stop treating your account like a lottery ticket and start treating it like a fortress. Lamdris the Byfunderi don't guess where the price is going. They identify a point of interest, they calculate the business expense of the risk, and they execute without a single emotion. In this video, I'm stripping away the retail noise. I'm giving you the exact rules of the games used by the biggest players in the world to dominate the markets. Man, forget the Wamoon shots. We're talking about institutional precision. If you can't follow these wood business rules for 1 month, you don't belong in this game. Listen closely, because this is where Byfunder Joder showed if you fail before you even place your first trade. You walk into this arena thinking about what you're going to buy with your profits. You're dreaming of the car, the house, the freedom. Meanwhile, the institutions, the real players, are thinking about one thing and one thing only: risk. In this game, your capital is not cash, it is not digital credit, it is your fortress. And in the next 10 minutes, I'm going to show you why your fortress is currently made of glass and how to rebuild it with reinforced steel. You know, the psychology of the fortress: most retail traders treat their trading account like a wallet. When you have money in your wallet, you're looking for ways to spend it. In trading, spending means clicking the you buy or sell button, but a professional doesn't spend capital. A professional deploys it. Lamjin, think of your account as a physical castle. Every dollar inside that castle is a soldier. If you send all your soldiers out into a foggy battlefield with no scouting and no plan, you aren't a general, you're a butcher. When those soldiers are gone, your castle falls. The game is over. Man, the fortress rule states that the preservation of the castle is more important than the conquest of new territory. Why? Because in the markets, opportunity is infinite, but capital is finite. There will be another perfect trade in an hour, a day, or a week. But if you blow your account today, you can't participate in the opportunity of tomorrow. You know, the Byfunder engineering, let's talk about the math of the fortress. Retail traders love leverage. They see a E-Ling account and try to trade like they have E-Buy. They risk Byfunder Shur, Byfunder Arsher, or even Byfunder Wusher on a single hunch. This is mathematical suicide. If you risk Byfunder Serper trade and hit a losing streak of 5 trades, which happens to the best in the world, you are down Byfunder Wursers. To get back to even, you now need to make a Byfunder E-Byte return on your remaining capital. Do you have any idea how hard it is to make Byfunder E-Byte? You've turned an uphill climb into a vertical cliff. The fortress rule demands a Byfunder E maximum risk per trade. When you risk Byfunder E, you could lose 10 times in a row and still have Byfunder courses of your army ready to fight. You stay calm, your pulse doesn't rise, your judgment stays clear. You aren't trading out of desperation, you're trading out of logic. The fortress remains standing. Pinder saying, emotional neutrality as a defense system. Why do people break the fortress rule? Igoriko. You want to be right. You want the market to admit you're a genius. So when a trade goes against you, instead of closing the gate and accepting a small loss, you leave the gate open. You hope the market turns around. Hope is not a business strategy. Hope is the scent of blood in the water. And the sharks, the institutional traders, can smell it from miles away. Motsixley say you're so bend in my world. We don't have feelings about a trade. A trade is a data point. If the data says the fortress is under threat, we cut the loss. We don't negotiate with the market. We don't beg. We execute the exit. The fortress rule means your self-worth is tied to your discipline, not your P&L profit and loss. If you followed your risk rules and lost money, that was a successful day. If you broke your rules and made money, you failed. Because lucky profits are just loans from the market that will be repossessed with interest later. Avoiding the casualty mindset. There are 2 types of people in the market: architects and casualties. Casualties are obsessed with the win rate. They want to win every time. Architects are obsessed with the risk to reward. An architect knows they can be wrong most of the time and still build a skyscraper. of wealth because their losses are tiny, the Byfunder E rule, and their wins are massive. Being to build your fortress, you must stop looking at the screen every 5 minutes. The more you watch, the more you itch to do something. Overtrading is the quickest way to erode your walls. Every unnecessary trade is a crack in your defense. Woo the Censor Day siege. If you want to be a millionaire in Censor's Days, your first task isn't to make a million. It's to prove you can protect what you already have. Prunders for the next Censor's Days, I want you to treat your account like it's the last bit of capital on earth. Mendian, no, and revenge trades. No, and no, I'll just risk a bit more this once trades. No, I have a feeling trades. Trans, you only move when your point of interest POI is hit, and you only risk what the fortress allows. Bondus summary, the commander's mandate. The market is designed to take your money. It is a machine built to transfer wealth from the undisciplined to the patient. By adopting the fortress rule, you stop being the victim and start being the machine. You are a general. Your capital is your army. Your strategy is your map. The fortress is your life. Protect the fortress. The conquest will take care of itself. Most traders fail because they have a worker mindset. A worker thinks, I worked for bought hours. I expect to be paid for bought hours. When they lose money in a trade, their brain registers it as a theft of their time and effort. They feel pain. They feel a need for revenge. Lend to reach $1 million level in Censor Days, you must delete the worker software and install the owner software. An owner understands one fundamental truth. You cannot have a business without expenses. The rent of the market. Imagine you are opening a high-end restaurant. You have to pay for the building, the staff, the ingredients, and the electricity. You don't walk into your restaurant at the end of the month, look at your electric bill, and start crying. You don't scream at the light bulb for stealing your money. Why? Because you know that the electricity was a necessary cost to generate the profit from the food. In trading, your stop loss is your electric bill. It is the rent you pay to stay in the market. When your POI trade hits your stop loss, that isn't a failure of your strategy. It is simply the market collecting its overhead. If you can't pay the rent with a smile, you don't deserve to own the building. The statistics of a CEO doesn't look at one day's sales and decide to shut down the company. They look at the quarterly report. Retail traders live and die by the next trade. They think the next trade defines their worth as a person. This is amateur hour. As an institutional boss, you should look at your trading in blocks of Arsers, Worsers, or EBAT trades. If your business plan has a Byfunder win rate and a cent reward to risk ratio, then statistically you know that Worsers out of the next EBAT trades will be expenses. You don't know which ones they will be. You might have 5 expenses in a row. A millionaire trader doesn't flinch during a losing streak because they know their inventory winning trades will eventually hit the shelves and cover all the costs. Bean Sand, killing the revenge virus. The most dangerous thing in a business is an emotional manager. When an impulse trader loses, they feel cheated. They immediately jump back into the market with a larger position without a POI, trying to take back what the market stole. This is called revenge trading. In the corporate world, this is the equivalent of a CEO gambling the entire company's payroll on a horse race because they had a bad sales week. It's insane, it's unprofessional, and it leads to a total collapse of the fortress. Lances, when you hit a stop loss, your job is to close the laptop and say, the bill has been paid. You walk away until the next point of interest appears. By treating the loss as an expense, you keep your emotional capital intact. Once you lose your emotional capital, your financial capital is usually an hour away from being zero. Sets.data versus drama. A professional trader's journal looks like a bank statement. Temdian entry, EDNR Wu Ling Ling, exit, EDNR Su Ba Ling, stop loss, expensed, Stendo E Ling Byfunder E, reason, POI invalidated by news. There is no drama. There are no exclamation points. There is no, I can't believe the market did this. Blanjet, if you want to be a millionaire in Sanders Days, you must audit your trades like an IRS agent. You Was the stop loss hit because you made a mistake impulse? Or was it hit because it was just a statistical expense? If it was a statistical expense, you celebrate. Why? Because you followed your rules. You acted like a boss. Woo, the free trade mental hack. Here is a secret used by the pros. Once you accept that a loss is just a business expense, you become fearless. When you aren't afraid of the loss, you can hold your winning trades longer. Most retail traders cut their wins short because they are so scared the market will take back the profit. But a business owner knows that the win has to be big enough to pay for the last 3 expenses. Playing it, you hold until your target is hit. You don't negotiate with your profit targets, just like you don't negotiate with your stop losses. In summary, the ledger of success, your trading account, is a ledger. On one side are the expenses losses, and on the other is the revenue wins. Your only job is to ensure the revenue is larger than the expenses at the end of the month. Stop trying to have 0 expenses. No business in the history of the world has ever operated without costs. Pay the market its rent, stay in your POI, and wait for the payday. This is the final piece of the puzzle. Keynote C, the liquidity hunt. This is where you pull back the curtain and show your viewers that the market is random. It's a predatory machine designed to find fuel. Pandron's Keynote says, the liquidity hunt, stop being the fuel. If you want to move into the millionaire bracket in Sansor's days, you have to stop thinking like a victim and start thinking like a predator. Lied. The market does not move because of news or feelings. It moves for one reason: liquidity. In the business of trading, liquidity is the fuel that big banks and institutions need to fill their massive orders. If they want to buy $1 billion worth of an asset, they need $1 billion worth of sellers. And where do they find those sellers? They find them at your stop loss. The engineering of the trap. Most retail traders are taught the same textbook patterns. You see a double bottom or a support line and you think this is a safe place to buy. You place your buy order and put your stop loss just below that line. Congratulations. You have just told every institutional algorithm in the world exactly where your money is. Expand to a bank, that cluster of stop losses is a liquidity pool. It's a giant pile of cash waiting to be taken. The market will intentionally push the price below that support line, hitting your stop loss and forcing you to sell just so the big players can buy those shares from you at a discount. The hunt before the move. Have you ever noticed that the market hits your stop loss and then immediately goes in the direction you predicted? That wasn't bad luck. That was the liquidity hunt. The institutions cannot move the market until they have enough fuel. The hunt is the process of clearing out the weak hands, the retail traders, before the real move begins. If you aren't waiting for the hunt to happen, you aren't a trader. You are the fuel for someone else's trade. The POI versus the trap. This is why the point of interest POI is so vital. A professional doesn't buy at the support line. A professional waits for the market to break the support, sweep the liquidity, and tap into an institutional order block hidden beneath the surface. The POI is the area after the trap has been sprung. Alliance. If you want to trade like a millionaire, you must learn to identify where the dumb money is hiding their stops. Look at the chart and ask, if I were a bank and I needed to steal $1 million to fuel my move, where would I find it? Once you see the trap, you don't fall into it, you wait for it to snap shut, and then you enter your trade. See the Sensor Day Predator shift for the next month. I want you to change your perspective. Stop looking for support and resistance. Start looking for liquidity pools. Look for equal highs and equal lows. These are magnets for price. Look for trendline liquidity where everyone is trailing their stops. Right.